Welcome. Tonight we're going to start with study unit 6, and this has got to do with the introduction to companies. So what is a company? Let's go through and just realize that a company is a separate legal or juristic person, right? It's a business, but it's separate from its owners. And it's registered and operated under the Companies Act 71 of 2008. So there's a piece of legislation that allows this business to be registered as a separate company. The owners are called shareholders, and they own a number of shares in the actual business. The main reason for a company, in comparison to a closed corporation or a partnership, is that we would like to raise larger amounts of capital. Okay, now there's two types of companies under the Companies Act 71 of 2008, either not-for-profit companies and for-profit companies. Yes, there's 4 different forms of for-profit companies, but we'll deal with those in a future lecture. Now, in terms of this study unit, you're going to deal with a lot of share capital issues. Okay, and here you're going to need to differentiate between authorized share capital versus issued share capital. Now, in terms of our MOI, the Memorandum of Incorporation, that's the founding document for a company, right? That gets registered with the CIPC. There you're going to have a maximum number of shares, and that will be called the authorized number of shares or authorized share capital. In some of the older companies who might not have yet converted to an MOI, you'll still see something called a Memorandum and Articles of Association. But not to worry about that for this subject. Those are for old companies before the new Companies Act was introduced. Now, authorized versus issued share capital. Understand that the company is not obliged to issue all of its authorized share capital. What it does do is issue the issued share capital, and that is what is shown in the statement of financial position, and actual share certificates are issued for those. The authorized number of shares is only what is disclosed in the notes. So how this works, when you register your company, you lodge the MOI with the CIPC, right? And this registration document, the MOI, will say the directors are authorized to issue 1,000 shares, for instance. But the directors may not want to issue those number of shares on day one. Maybe they only issue 100 shares. Yes, we'll put a value to those shares, but there's a big difference. The 100 shares times XYZ number of rands is how much is issued share capital. The other shares are just authorized, still waiting to be issued, but authorized gives us the maximum number that are allowed to be issued. Obviously, if we land up issuing all authorized shares and we need to issue more, well, we'll have to go and change the MOI. Just also remember, you might have heard of things like par value shares and share premium. That's all changed. There is no more par value or nominal value shares. Okay, it's the old Companies Act before 2008. Therefore, there is no more share premium. And we often call the share capital account now the stated share capital. What I need you to understand is in the statement of financial position, equity is represented differently. In every study unit so far, we've had to make a change here. So we had a sole proprietor from FAC1601, where you had a capital account and reserves. The business and the owner were the same. Partners, well, we'd have a capital account for each partner and current accounts for each partner in the partnership. We still had reserves, such as the asset replacement reserve or the revaluation reserve. Again, both for sole props and partnerships, there is no separate legal person. The partnership or the sole prop, the business, and the individual owners are one and the same. But then we dealt with closed corporations. Closed corporations were separate juristic persons, legal persons, and we called the equity members' contribution, and members owned a members' interest percentage. We had then accumulated profits or retained income, and reserves were still there. we had a big change in terms of there was no drawings in a CC. The drawings related to partnerships and sole props. Closed corporations, you refer to any cash withdrawals by owners as distributions. Now onto companies. Companies are no longer referring to members' interest. We deal with share capital. We still have retained earnings and reserves, however. Those are exactly the same. When we pay out profits to the shareholders, we are going to call that a dividend. Okay, so this is important. In this study unit, you're not going to be tested in detail in companies, but you are going to be tested in detail about the shares, share issues, capitalization issues, etc. that are going to affect this share capital, and you're going to be tested on dividends. Okay, nothing more, nothing less. Not a huge section, but it does come up for a little bit of marks. And you need to know what you're doing, and it's vital that you get on top of this for the second year subjects coming up. Thank you.